Industry Voice. Which assumptions really set power purchase prices and returns in United States solar projects? Most solar teams do not suffer from a lack of data. They suffer from a lack of hierarchy. In a typical underwriting cycle, a deal model may carry dozens of assumptions that feel important. Debt terms, escalators, O&M, incentive mechanics, contract length, and more. Those inputs matter. But when you evaluate what moves project value, equity returns, and the PPA price required to clear a target return while still meeting DSCR constraints, a stable pattern emerges. The stable pattern is this. 3 assumptions do most of the work across outcomes. 1. Delivered capex per watt. 2. Bankable production yield, measured as net kilowatt per kilowatt. 3. The base PPA rate. Everything else tends to be a modifier unless it materially changes one of those 3. That hierarchy is not an abstract observation. It shows up directly in the base case sensitivity results. The representative project used in the analysis includes a base capex of about $2.50 per watt, a first-year production yield around 1,321 kilowatt-hours per kilowatt, and a base PPA rate around 144 per kilowatt-hour, with standard financing and tax credit assumptions. Under one-at-a-time scenario sweeps, the largest impact consistently comes from changes in cost, energy, and price. Why does this matter for the U.S. renewable energy sector as a whole? Because scaling is a throughput problem. Every week spent debating second-order inputs is a week not spent tightening the levers that reduce tariffs, protect lender confidence, and turn interconnection positions into operating assets. Here is a clean way to think about economics. A solar project converts upfront dollars into delivered energy, then converts delivered energy into contracted revenue, then converts that revenue into debt service and equity cash flow. Delivered capex controls the first conversion. Bankable production controls the second. Base PPA rate controls the third, especially in early years when DSCR often binds. This also explains a counterintuitive result that experienced underwriters will recognize certain debt terms that can matter less than expected in a DSCR sculpted structure. When debt is shaped to coverage, some interest rate impact is partially absorbed by changes in amortization and timing. That does not make financing irrelevant. It means that in a typical DSCR-sized deal, cost, energy, and base price often dominate the direction and magnitude of outcomes. So, what should decision-makers do differently on Monday morning? Developers and EPC teams treat delivered capex per watt as a controllable strategy. Capex is not just equipment and labor. It is interconnection scope, schedule risk, civil complexity, and the change order surface area built into the design. If the goal is to sign lower PPAs without sacrificing bankability, capex takeout is usually the cleanest lever because it reduces the equity check, improves early cash coverage, and typically strengthens multiple metrics at once. Practical moves that translate to financeability bring interconnection and owner scope cost discipline forward, not after site control. Standardized design choices that reduce late surprises at the point of interconnection and commissioning. Value engineering around dollars per bankable kilowatt hour, not dollars per watt on a bid sheet. Performance and asset management teams make production bankable, not theoretical. Bankable production is where engineering becomes finance. It reflects availability discipline, defensible loss assumptions, degradation treatment, and curtailment realism. A small improvement in net kilowatt-hours per kilowatt can lift value and lower the PPA floor, but only if the improvement survives scrutiny from lenders and investors. Practical moves. Tie production claims to verifiable operational plans and enforceable guarantees. Treat curtailment, clipping, and loss assumptions as credit items, not technical footnotes. Focus on first-year net energy and early-year coverage performance, since DSCR binds early in many structures. Corporate off-takers and public sector buyers ask for price improvements where the model can pay for them. Many negotiations concentrate on escalators or long-tail provisions, while the base price remains at the central level. The analysis shows that base price shifts and unit economics shifts tend to dominate, while escalator effects are often smaller in present value terms than stakeholders assume. If a buyer wants a lower tariff without forcing a seller to accept weak economics, the constructive path is to pair the request with one of the true levers. Support lower delivered capex through coordination on interconnection, schedule certainty, or risk allocation. Improve bankable production through site selection, design alignment, and performance clarity. Be explicit about return expectations and what trade-offs are acceptable. Lenders and credit teams concentrate diligence on the drivers that move both price and resilience. A useful underwriting discipline is to stress the same three levers early: capex, production, and base price. These variables drive not only sponsor metrics, but also the project ability to maintain coverage. Practical moves: run downside cases on production and upside cases on capex as standard, not optional. Treat contract provisions that protect realized revenue per kilowatt hour as credit critical, including curtailment treatment and price floors where relevant. Evaluate whether the structure is truly DSCR driven in early years, since that often determines which knobs matter most. Policymakers and market enablers prioritize interventions that push the same top levers across the pipeline. The fastest way to expand solar deployment is to reduce delivered cost, improve bankable production, and cut transaction friction that delays contracting and financing. Programs that improve permitting predictability, interconnection throughput, and standardization of contracting mechanics often deliver compounding benefits: lower all-in cost, fewer delays, and tighter confidence from financiers. The broader takeaway is optimistic. The U.S. solar market does not need perfect forecasts across dozens of assumptions to scale. It needs alignment on the few levers that consistently determine whether a project can offer an attractive price, satisfy lenders, and deliver returns. When stakeholders focus on delivered cost, bankable energy, and a base price that reflects real risk allocation, projects close faster and capital flows more efficiently. Kshitiz Raj is an energy finance specialist, focusing on U.S. solar and BESS project finance. Kshitiz has supported pricing and capital allocation on PPA structures, built project valuation and tax credit models, and worked in structured finance and banking for several years. He holds a master's degree in management sciences and quantitative methods from Duke University.